Please note the information on Retire Vivid referenced in this video is accurate as of December 6, 2024. Changes to laws and regulations may make portions of this segment outdated and no longer relevant. Information presented is for educational purposes only and is not intended to provide investment, tax, or legal advice. Please see our full disclosure at the end of this video.
Welcome to Retire Vivid. I'm Karen McCarty. That's Tommy Breitbach. And today's episode is on planning for Social Security. I mean, it's a big decision in terms of when you take your benefit. Because if you think about it, Tommy, I mean, people don't have pensions anymore. They have their IRA 401ks, which happens to be their largest assets, and they have their Social Security. But the question is when do you file for Social Security?
Right, and you know, we've mentioned this before, but retirement is an income problem, not necessarily an asset problem.
Right.
Social Security becomes a big part of that income piece as we look at pensions kind of going away.
That's right.
So it's important to review kind of what you have going on, what you're looking forward to, and does it make sense to claim early, delay, somewhere in the middle?
Right,
kind
right.
of all of the circumstances surrounding their situation.
A lot of people, I mean, we live in the information age, right? People do a lot of Googling. When do I take Social Security? And what's interesting, a lot of times it says delay, 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 meaning wait till 70. Well, okay, so we got the answer. Let's tell our viewers, wait till 70. Well, does that make sense for everybody?
No, it
doesn't.
Your individual situation determines kind of your best option.
Right.
It's when do you want to retire? Do you have the financial means to retire? Does Social Security make sense? Early, middle, late?
Right.
All those pieces together.
Well, see, I mean, but where I'm getting at with the age 70, I mean, that's a long time. I mean, and you know what? If I'm encouraging somebody to delay, I better have a darn good reason why, in my opinion, right? Because what do people usually say to us? What if I don't live to that point? Right? Because how many people, would know somebody retired and maybe a year later they passed away?
Yeah, we've come across it. It's a very real consideration.
Absolutely it is. And so today, folks, we're going to be going through Social Security planning. We'll walk you through a couple in terms of decisions they have to make. But before we do that, let's talk a little bit about the milestones. Right? There's different things when it comes to Social Security. So Tommy, let's start with age 60.
Yeah, age 60. So at age 62, most people's workers' benefits start. 2 years prior to that, age 60, there's an option for a survivor benefit if we've lost that spouse.
Right, and so that's a survivor benefit, and I think that's, I think a lot of people don't realize that. I think they think they have to wait until age 62 because that's when a majority of Americans have to file for their benefit.
It is maybe a relatively unknown, benefit at age 60.
And then we fast forward to age 62, and that's when a majority of Americans can take their Social Security benefit.
Yeah, so most people have a full retirement age, falls between typically 66 to 67. At age 62, you're eligible for an age-based reduction. That age-based reduction is percentage-based, so the earlier you claim, the bigger reduction you have to your full retirement age amount. Typically starting around 70% at age 62, and then increasing up to 100% at full retirement age.
Right, and everybody's different. It really, it just depends on what the year you were born in terms of what your full retirement age is. But one other thing I want to talk about is, let's talk about that from 62 to full retirement age. There's something called the earnings test. This is a big one, Tommy. So let's talk a little bit about how this works when it comes to people that are still working and may want to file for their benefit prior to full retirement age.
Social Security from a tax perspective is kind of a retirement benefit. So if you are making too much past that earnings limit amount, they can take some of your Social Securities back. So in 2025, from age 62 until the year before you reach full retirement age, or through the year before you reach full retirement age, that 2025 earnings test amount is $23,400. And so if you're looking at retiring or going to part-time income, you want to keep the $23,400 in the back of your mind.
And then the year you turn full retirement age, it goes up to over $60,000. That's a pretty big jump from $23,000.
Yes, and so the year you reach full retirement age, if your full retirement age is 66 in 6 months, birthday's in October, you go out that next April, you'll hit full retirement age, or if your full retirement age is 67, that year you reach full retirement age, the amount increases substantially.
That's a pretty big jump. But people got to be careful of this because, again, we don't want people getting hurt out there where they go, well, they come in and say, Cam, what happened to my Social Security? You had a good problem. You made too much, right? And well, you can't make enough. But the point is in Social Security's eyes, you made too much. And so be careful of that. But once you turn full retirement age, it's unlimited.
The earnings amount becomes unlimited. And if you are under that earnings test from 62 to the year you reach full retirement age, every $2 you make over the amount, they take $1 back. The year you reach full retirement age, that goes to $3 over,
3 to 1.
$1 back.
Yep.
That money's not gone. It is just deferred. They'll recalculate it when you hit full retirement age, kind of pay you back for what they've retained. But
Right.
If you're going to be done and you are making in that range, review it, keep it under that.
Or just don't mess with it, right? I mean, we don't want that. And there's another big age, which is Medicare, right? Because a lot of people, let's say they have the financial means to retire, but what do we all need?
Healthcare.
We all need healthcare, and Medicare is age 65. And if you delay your Social Security past full retirement age, you get a pretty darn good credit there.
Yeah, so from full retirement age up to age 70, you get a delayed retirement credit. That's currently 8% a year. It's a pretty good.
That's pretty strong.
8% guaranteed return on that amount. That's a good amount.
But what's the deal?
You wait.
You wait. That's the sell, right? That's the tough sell. You got to wait because then Tommy, once you reach age 70, your benefit stops growing. So this is the milestones.
These are the milestones, yeah. And if you've hit age 70, get your Social Security application submitted.
Otherwise, what are we doing?
Taking them.
Uber Tommy. we're gonna take them to the administration because we're just missing out on benefits. So next, what we're gonna do is we're gonna be giving you an example of a couple. Also give them some alternatives. They have these IRA accounts. What makes sense for them from a retirement perspective, and when do they file for Social Security? More right after the break. Welcome back. Okay, so we just talked about the milestones when it comes to Social Security. We're now going to give you some really solid information when it comes to planning. So, Tommy, again, there's a lot of decisions when it comes to filing for your benefit. We obviously just talked about that. But, what do you think one of the biggest questions people have when it comes to Social Security in terms of planning that you hear?
That I hear, it's either should I not claim early, or how long should I delay? And it's, there's an infinite number, not infinite. There's a, vast number of combinations. You can claim at any age and months, but finding kind of a balance at just different target dates may make sense just to guide the planning process.
Right, because again, I think like we talked about earlier, boy, would I love to see those higher numbers in terms of that retirement, because you said something that really hit home, right? Because people hear on the radio or whatever, you got to have $1 million to retire. Well, that's not necessarily true. It comes down to how much money do you need to maintain your lifestyle. Right.
And a lot of people are looking at a combination of Social Security and account withdrawals, if it's IRA or other types of accounts they have. But, mentally it's hard to get from saving to just taking a large distribution every year. It messes with you. And so it's, if you can find an income number that makes sense, but it's also not restricting what you want to do in retirement.
Sure.
That's kind of the happy medium in there.
So let's talk about this. Okay, here we go. So In this example, we're going to follow along with this married couple. It's John and Jane Smith.
Pretty generic.
Pretty generic. But kind of, in terms of, it gives them a scenario of what we look at when we're meeting with people. So here we got John. John's 61 years old, okay? Jane's 59. And they're looking at retirement planning. They're saying, hey, when can I retire? So the first thing we want to know is what is your full retirement age? So John brings in his statement, and his full retirement age is $3,400 in terms of what he's going to get at his FRA. For Jane, hers is $2,500. Okay, well, why is it lower? Well, she had the toughest job of all. She was raising kids. So now that we know that, we need to input some assumptions, right? Because we got to put something in there. In this case, we're going to show a 2% inflation, and life expectancy, we're going to show John living to age 88 and Jane living to age 92. And again, I hope they live longer than that, but I got to put something in there. So Tommy, once we put this in, our analysis will spit out this report. So let's dive into the first one.
First two options that come out of the report are the earliest claiming option and the latest claiming option. So in the earliest claiming option, they both file at 62. John will be making $2,394 a month. Jane will make $1,795 a month.
Right.
Total, the present value of lifetime benefits, so discounted by that 2% inflation, the COLA you mentioned.
Yep.
The cost of living adjustment. The expected lifetime value of that is $1,417,183.
In change.
In change.
Okay, so but that's good to show people, because again, it's not just the dollar amount that they're going to receive today. It's also, what are you going to receive over your lifetime? If I had a crystal ball, I could tell you exactly when to file for your Social Security benefit, but we don't know that. And so in this example, if they live to these ages, this is what you're looking at for benefits. Okay, we know that now. Now, that may not make sense for everybody to file right away at 62, but let's just show on the very far end of delaying their benefit completely.
So if they both delay to age 70, we talked about the delayed retirement credits after full retirement age. John's benefit will be $4,939, and Jane's benefit will be $3,704.
Yeah, great benefit.
The numbers sound nice, but they've also waited an extra 8 years to get from
you gotta wait to get it.
62 to 70.
Now, what's their lifetime benefit on this?
Yeah, the expected lifetime benefit of this is $1,769,000 and change.
And change. That's a pretty sizable difference between the two, right? I mean, you're looking at, in terms of what's at stake, in terms of a decision, right? That's a $351,000 plus decision that these people need to make. I mean, think about that, because if you take it early versus delaying, you're leaving $351,000 on the table if you took it early.
I
get it, yeah.
If you make it to kind of the stated life expectancies in these assumptions. And that's kind of always the wild card. Typically, your break evens across the number of different strategies end up in the late 70s to early 80s.
Right.
To where claiming early, I guess, or exceeds claiming later, and then they catch up late 70s, early 80s.
Yep.
The life expectancy does make a big difference in these assumptions.
Oh, huge.
So if there's concerns about not making it to a certain age, or there's a belief of longevity, assumptions can change in there.
Well, and that's the thing. We got to show something, right? We got to show something. So, but here's the thing. It's nice to show filing right away versus delaying fully, because it gives us those two numbers. But guess what? That doesn't fit everybody. Because again, we just talked about it. If I encourage somebody to delay, in my opinion, I better have a darn good reason why, right? And I'm going to show some alternatives of what we usually do. But again, there's so many combinations, like you mentioned. So let's talk about this. Let's talk about some alternatives. So Tommy, let's first talk about this one here. Alternative one that you and I created here. So in this case, we got, instead of waiting until 70, we're going to have John file at full retirement age. It doesn't mean he's working until full retirement age. It just means he's filing at full retirement age. That's $3,753 a month. And then Jane is going to file at 65, and that's $2,345. I mean, if you look at the difference in terms of that lifetime benefit, look how much closer we're getting to that maximum one, if you would.
This example, the lifetime benefit is $1,609,000. And so, you are looking at delaying, but kind of finding that middle ground. And again, you mentioned you don't have to work until you claim Social Security.
Right.
Maybe you work until Medicare at age 65 if that's important, the healthcare piece.
Yep.
And then if you have outside resources to use for a couple of years, letting the Social Security benefit continue to grow, and then filing, in kind of the middle ground in there.
Yep. So next is, okay, that one's not bad, but this one actually was really intriguing. And this one is alternative 2. And so this one, we have John filing at 67. Again, doesn't mean he's working until 67. He's filing at that age, but then Jane files right away. I kind of like this one. This isn't bad. And she's going to get $1,795. Now, I look at the difference. The numbers are still pretty far apart, but again, let's be realistic, right? I mean, what happens when we lose a spouse, Tommy?
The lower benefit goes away.
The lower benefit goes away. And so, this is just me talking, right? I mean, everybody's different that's listening here. What if we had one spouse take that benefit right away, usually the one with the lower benefit, get that cash flow coming in because we're young. We're in our go-go years, right? You're going to probably spend more money than you are now than you are going to be in your early 80s. And then the other spouse potentially wait for tax purposes, which we're going to talk about next, and a survivorship benefit as well.
There's no one-size-fits-all solution, but as you're going through that planning process, if you have an income number in mind, how do we find a combination of Social Security benefits that make sense? You have outside assets, withdrawal rates, all those things, but how do you find that combination that makes sense for you?
And that is why we offer that 15-minute retirement review. I mean, Tommy, these are the things that people want to know. And that's also why we're doing this show. But people may have those quick questions. I mean, especially when we're talking about Social Security. Again, for a lot of people, it's an irrevocable decision. But also, how does your IRA play a role into that? When do we file for Social Security? What's your retirement plan in general? Tommy, that 15-minute call has been extremely valuable for people that have reached out to us.
Then if it's a quick question or something they've read and just looking for clarification, a lot of times we can provide an answer or help them get in the right direction.
Absolutely. So we encourage you all to take advantage of that call. Next, we're going to talk about the big one. You get a wonderful tax preference with your Social Security right after the break. Stay with us. Okay, we just talked about a lot. So again, we just talked about the milestones. We talked about Social Security options. We're following this couple, John and Jane Smith. And so we went through all their options, right? We knew their situation. We gave them those 4. They chose to do alternative 2, Tommy, which was him filing at 67 and her at 62. But keep in mind, I want to be clear on this. It doesn't mean that he's working until 67. It just means he's waiting until 67. And she liked the idea of filing for her benefit. So again, the next piece is taxes.
Yeah, and as we get into taxes, if they are taking distributions to bridge that gap from retirement to filing. But in this scenario, we're going to look at the tax preference you get with your Social Security benefit.
It's a good one.
It is a good one. And it's,
the best kept secret.
It's one of the best kept secrets.
I'm stealing your line.
It can be kind of confusing, but we'll put some real numbers out here.
Sure.
So you can kind of follow along, see how the provisional income formula factors into tax returns,
Sure.
kind of all that stuff.
Why don't you kick us off? So let's just say in example 1, in terms of an income need, they could live on just Social Security. Walk our viewers through that.
67, 62, that first year, they both have a full Social Security benefit. We rounded the number up to 68,000 even for ease of providing numbers. Their benefit's a little under that. But with
68,000.
But with 68,000 of Social Security benefits, they're going to show $1,000 of adjusted gross income. Only $1,000 of that Social Security benefit is shown as taxable. You get your standard deduction. There's no taxable income. They're paying no federal taxes.
No Fed tax on 68K.
No Fed taxes on 68K. And that's the power of the tax preference with your Social Security benefit.
I think the big thing that people need to know when it comes to how Social Security is taxed, I mean, this is kind of a weird way of putting it, but it's kind of like a tube of toothpaste, right? It's not taxed, your Social Security is not taxed unless more pressure gets pushed on it, right? So an IRA distribution, a pension, W-2 income, that's what causes your Social Security to become taxable. And so in this case, there's no pressure. So it's showing no taxes in terms of your Social Security benefit. Let's move it up. So okay, that was that number. But now let's say this couple needs $90,000 for a standard of living. Walk them through that.
$90,000, and we're showing IRA or taxable reportable distribution. So
Right.
if you're looking at Roth IRAs that will not show as reportable income, qualified dividends, long-term gains, those show differently. But in this case, $68,000 Social Security benefits, $22,000 from the IRA to get you to the 90.
Yep.
Their AGI is right around $38,000. They're showing about $748 in Fed taxes.
$748 on $90,000 of income.
Again, highlighting the tax preference of your
Not
Social
bad.
Security benefit.
Yeah.
That is not a bad deal on $90,000 of income. It won't look like that if you have $90,000 of wages.
Well, and I tell you what, folks, again, this is why you work with people who know what they're doing, especially now, if this was a couple and this is all they needed, guess what I may be looking at? Roth conversions, right? Because of the tax bracket they're in, right? Because again, we don't want to pop into another tax bracket. We want to stay in those lower tiers, right?
And that becomes another episode. But yeah, you're looking at your your IRA accounts at at age 73 or 75, depending on age. You have your required minimum distribution. So if you're only using a little bit, your IRA accounts are sizable. You are going to be forced to take more in the future. And so that's where you're looking at the tax preference you get with Social Security and also tax planning.
And so the big thing here, folks, in terms of how we're getting these numbers, I mean, we are a tax firm also. And so we are putting this into a tax planner, putting assumptions behind it in terms of what we're trying to figure out, standard deduction, and also the age too. You gotta be aware of that. When you cross over age 65, so on and so forth. But again, we gotta give our viewers some type of numbers. Okay, that's 90,000. They want more. They say, I want more. They want $120,000 of income. Okay, still the same 68,000, Tommy.
68,000 Social Security, that gets you 52,000 from the IRA.
Yep.
You're showing just over $7,000 in Fed taxes.
70, right around, just under $7,500. That's it on $120,000. Think about that effective tax rate. It's a low one.
It is low, and that's why we talk so much about planning and Roth conversions and combining Social Security with taxes. Everything comes together, to find the right solution for you.
I mean, that's still a pretty good deal. I mean, if you think about it. But again, I mean, if somebody, if somebody's in those lower tax tiers, I still would also encourage you to talk to a professional, right? Again, we don't know the people that are listening to us right now, so we do a blanket of an education, right, in terms of what we would be focusing on, and look at a Roth. Okay, next, 150. They say, wait, I want more. $150,000.
$150,000. That same 68. You need 82 to get to your 150 a year. The federal tax liability on that is just over $14,000.
Yeah, still not horrible.
Kind of right in the range of just under a 10% effective tax rate on your gross income.
And you're in the higher tax tier on this one.
And this one you've bumped from the 12 to the 22.
That's a heck of a deal. But you know what? One thing is let's just say somebody needed a certain dollar amount, but then they don't pre-plan for the required minimum distributions. So let's say they've been a good saver, right? They weren't pulling out enough, right, from their IRAs. That could happen. I mean, that could put people into those higher brackets and causing more and more of our Social Security benefit to become taxable. I mean, it's a good problem to have, don't get me wrong, but wouldn't it make sense to do some tax planning before that time actually comes?
Right, and that's another episode if they want to go out to, Retire Vivid on YouTube. We have that out there. We talk about tax implications specifically, but this one, Social Security, how everything comes together.
Well, I'm glad you mentioned that. I mean, if you want to learn more about what we're talking about today, there are a number of ways that you can. The first one is you can see other episodes of Retire Vivid at YouTube. I mean, we got a lot of great things that's out there. We even have some full episodes out there that we have filmed in the past, so make sure you take a look at us there. And also, if you want to learn more about the company, you can go to Facebook or our website at retirevivid.com. So again, folks, I hope you learned something today. This is a good I thought it was a good episode.
This was a good episode. I felt like we went quick.
We went probably too quick. I mean, it's probably clear as mud for the viewers right now. But folks, thank you for listening. I mean, remember, we're on every weekend, again, helping you, guiding you, giving you the tools you need so you can make an informed decision during your retirement journey. So we'll catch you next time right here on Retire Vivid.
Do you have questions about your retirement plan, or do you want to know if you are on the right track? We are here to help. Simply go to retirevivid.com or call the number below to schedule a 15-minute retirement review. You can speak with us about taxes, Social Security, your 401k, or any quick retirement questions at no cost to you. We are here to make retirement vivid. Schedule your 15-minute retirement review today.
Cameron McCarty and Tommy Breitbach are investment advisor representatives of Vivid Wealth Management, a SEC-registered investment advisor located in Des Moines, Iowa. Investment advisory services are offered through Vivid Wealth Management, LLC. Insurance products and services are offered through Vivid Tax and Wealth Advisors, and individually licensed and appointed agents. Tax planning and preparation services are offered through Vivid Tax Center, LLC. The preceding entities are affiliated. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Case studies and examples presented are hypothetical and used to demonstrate a concept. These studies do not represent actual clients or results. Similar or even positive results cannot be guaranteed. None of the entities above are affiliated or endorsed by the Social Security Administration or any government agency. Information expressed does not take into account your specific situation or objectives and is not intended to provide investment, tax, or legal advice. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Investments involve risk and, unless otherwise stated, are not guaranteed.